This is our Forex blog for May 31st, 2013, and one of the reasons I go over our currency indexes each day is it's the absolute easiest way to trade Forex that I've come up with over the last 8 years. And what this is a visual chart like description of what each and every currency is doing. We compare all the dollar pairs together and create a chart. You can quickly see if it's going up or down. You can see the previous day's high in green, dotted green, previous day's low and dotted red, the point of control the previous day, the price most traders had positions in yesterday and all the dollar pairs, major area of support, and when it doesn't break down underneath that and it breaks out over the high, it's likely to go up. This is the previous week's most actively traded price, where most of the positions for the previous week are right here. This is obviously going to be major resistance area. It's a great profit target and a place to, when the market fails to go higher and breaks down, it's a great place to go short. Currencies that have a daily and weekly trend that's up and it breaks out over the previous day's high, many times continue trending up. You can see here for an hour and a half. So this is a phenomenal one, the Swiss, to be buying right here. And you'd want to buy it versus, obviously, the weakest. You wouldn't buy it against the yen, which is exploding up right now. In fact, it's going up at a more rapid pace than the Swiss. The Australian's going down. The New Zealand's going down. The only downside with both of these is, for about an hour and a half, it's already been trending. So it might get a little bit of a pullback before it goes. Anytime you see a currency kind of break out right here, and this one's been going up an hour and a half, and this one's been going down an hour and a half, you might get into trade lose, wait for a deeper pullback, and then you make a big profit on the next one. But take a look at this at 3:30. We're going to sell the Australian Swiss and New Zealand Swiss, and also we'll look at selling the CAD Swiss because it's also trending down. Then it hasn't gone down as much, so you might have potentially more profit upside. You never know. You can never anticipate which of the three pairs is going to make a big move, but usually out of two or three pairs in one strong currency, three weak ones, one of them is going to move 20, 30 pips most of the time. So the only way to ensure that is to take every trade, but a lot of traders can't manage multiple trades at the same time. So we're going to look at the Australian Swiss. Remember, this was around 3:30 right here that the Swiss is breaking out over the high. And you can see that this one, like I said, has already been trending down for about an hour and a half. But at 3:30 right here, you can see it went down from 91.80 to 30. It's a 50 pip continuation. So in this case, it pretty much went your way immediately. There was no small loss before the second wave. You have a nice little pullback trade right here where you can short. And we always basically put anytime you short a little range like that, normally I put my stop over the high here. So this is what your risk is here. Once the trade kind of goes your way, you move your stop in half very quickly. The second trade is very tiny risk. First one, move this many pips. You never catch all of it, but assuming you catch half of that, that's a nice 1.5 to 2 times bigger profit than what your risk is. Same thing with this one. If you even got half of this, you made more than what your risk is, and that's really the key to trading. The other one that we saw on there was the New Zealand Swiss. 3:30. You can see that this one also continued down. Now, honestly, I don't think I would have taken this one because usually the 2.0 white lower band is where the market reverses. So if you short here with your stop above here, your potential profit may not justify that. If you want to take the trade anyway, what I do is on trades that I don't like because of risk versus reward reasons, but I do like based on the chart pattern, I'll typically trade half to 70% of my normal trade size. That way I realize that if the trade doesn't work out and I lose, I don't lose as much as I would have. But if it does turn into a big win like that, I'm not kicking myself for being a little wimp for, not taking a good trade. Currencies typically most times when they're oversold, they'll bounce up. When they're overbought, they will reverse. But every once in a while, they will go outside of these bands, which are statistical in nature. A perfect oscillator, usually when it hits a minus 80 level, you get a reversal. And almost every time you get a minus 80 level and it kind of retracts a little bit, the second time down, it typically is going to reverse. If you look at later in the day, when these things hit the -80 level, you got kind of a sideways down, then reverse. Right here, you had a nice reverse. Right here, you know, the market kind of inched up. Right here, kind of inched up. Right here, it failed, obviously, but the second time, you know, you got it kind of a little bit of a move up, and it's kind of going sideways right now, towards the end of the day, obviously. Let's take a look at the CAD Swiss. Now remember, the CAD was slightly trending down. The Swiss was breaking out. It's very likely 330 to go down. What's nice about this one is you can see it hadn't fallen too much, and that's one of the reasons why I like currencies that maybe if one currency is super strong and the other one's just slightly weak, but it hasn't moved too far already, you have, you know, the potential of this lower band, which most of the time contains price. If you notice, the low here, here, and the high here are all at our 2.0 containment band. So this is why I really don't like to sell right in front of it, because typically you're going to, if you're lucky, make 10 pips, and then it reverses. I mean, you can always take a trade that's above here, and if it only goes 10 or 15 pips and it stalls there, you get the hell out. You run for the exit. And also notice the -80 level. You know, here, here, up at the highs here and here. This one right here, pretty much, you know, reversed 15 pips, had a quick little shot up, and then came back down. Most of the time, at these plus and -80 levels on a perfect oscillator, it's going to reverse. And you know, there's so many different ways of trading. Even though the trend's down, if you see on a perfect oscillator, the moving average of the oscillator is this little white line right here. When it's above the dotted 0 line, it means the trend's up. And when that basically happens, you can, you know, for a scalping basis, look to get in at the lower bands right here. As you can see right here, nice little 10 pip pop right here, nice little 15 pip pop, 20 pip pop. You know, when the trend's up, typically you can look to get into buys at the lower band. You know, right here, quick little 20 pip pop, and then right here the trend's down. Obviously, it came up and hit the upper band right here. You do have to be aware of where the hourly moving average is. Above the hourly, it tends to go up. Below it tends to go down. But you can see 3 out of 3 times when this Swiss broke out right here, and you can see on the chart that this one just continued down. This one did. This one kind of drifted down. These tools are very predictive. I mean, you can see when previous day's high in the pound is hit twice, can't get above it, the daily and weekly trend's up. When it finally breaks out here a little bit before 5, which currency is the weakest at that time? Well, the dollar and the yen are trending up. These two are weak. The CAD had trended down, and we have a nice little pullback right here. Let's go a little bit before 5. This is something I don't share in class too much, mainly because it's more complex and some traders aren't going to get it. But if you understand this, you can make a living trading. If you see a currency, you know, coming back up to its highs, and assuming it breaks out, it makes a higher high than it did all day yesterday. All the pound pairs basically are higher than yesterday is what this is saying. And you see another currency that's been trending down, and you have a nice little pullback right here. This is an ideal trade because the daily and weekly trend are down, the trend's down. This one is at its lows, and it certainly could go down even farther, but it's at the lower containment band. It maybe doesn't have too much far to go. This one has pulled back and kind of reset itself. So if this one it explodes up, this one's already pulled back a decent amount. It's at resistance right here. A support area, once broken, becomes resistance. It's likely not to go above that. And if it starts to fall and the pound breaks out, the pound CAD is going to be one hell of a great trade before 5 o'clock. So let's take a look at the pound CAD. And you can use any time frame charts. I just use 5-minute on here just because it comes up quickly. So you can see on here, before 5, this one trended up considerable distance, and you had a little bit of a pullback right here before 5. Notice the moving average on my perfect oscillator is above the 0 line. Notice also the pullback right at the lower Bollinger Band that I also told you about. Great place to get in, and this is your profit target, and it went a little bit beyond that. But even if you got out with maybe just half of what that profit is, it's a big profit compared to the tiny risk. And this, I will finish class today by going over range charts and tick charts. If you bring up the pound CAD and put 5 pips per bar, 5R, this is going to show a range chart with each bar being 5 pips. So now you can really see a pullback a little bit better at that time. So coming up before 5, you can draw like a trend line. I'll just use a regular line tool. Trend line over those bars high, and after a decent sized pullback, and you already saw that it hit the lower Bollinger Band on the perfect oscillator, you have a nice high probability place to get in. And you can also, if you want, and this is a separate tool, use a separate, I usually show the containment bands with the hourly data. It shows an hourly moving average or exponential or digital signal processing based moving average in the upper and outer bands. You can put a 5-minute on here and also click the DSP, and it might just be at the lower band. In this case it's not. Probably maybe a 2-minute or a 3-minute band it would be. Typically I'll use the 5-minute. Let's see if the 3-minute got hit here. Yeah, not quite. It might have hit the 2-minute bands. These are super fast bands. Yeah, I might have to start using the 2-minute. That looks pretty damn good. But anyway, you draw a trend line over there, you get in, and basically your risk would be a pip or two underneath that bar's low. And if you have these faster bands on here, you might shoot for the upper band as your profit target, or better yet, draw your fibs off the last wave up, and have the patience and discipline to wait for that profit target, because most strong trends are going to work their way to that fib target. Now you have this is a potential profit, and this is what your risk is. It makes sense to take the trade. It's probably 40 to 70% depending on the day and what the previous longer term trend of this pair is, to go to that level, and your risk is this small. I mean, anytime you can make 20 or 30 pips while risking less than 10, you got to pull the trigger, or at least on trades that you have the potential to make 20 30 pips. Sometimes you only make 5 or 6, even though the trade looks phenomenal and it looks like it's going to give you 20 to 50. That's just the way the market is.